It is interesting how many gurus on YouTube enjoy fooling people on their stock market predictions that sometimes happens and most of the time don't. Instead of trying to predict the stock market, they should start to study real indicators, like VIX or repo, and just follow the trend until the end. So here is my first golden egg for investors and traders like you. It doesn't matter where the price will be in the future, just follow the money now and don't try to predict anything. I have never seen any of them talk about the latest VIX long-term breakout, and how similar it is to the one that happened in March 2007, 7 months before the S&P 500 peaked, in October 2007. So, stay tuned until the end, because, in this video I will explain how to analyze VIX and share all the details of the recent breakout. That could be a huge signal to investors like you. Welcome, I am Edward Cash Trader, with more than 30 years experience in the stock market, and I have created this channel because I was tired of watching those so-called stock market gurus, fooling everyone with their stock market predictions and stealing money from them. In this channel, I will explore a complete new trading perspective, using real indicators that are much more complex to analyze, but have a much higher percentage of accuracy than those kids' indicators like MACD, RSI or candle count. Now, let's go right to the chart because we have a lot to cover. So, let's go back to February 2020, and, as you can see, VIX has been on a clear long-term downtrend. After many attempts, VIX finally broke out of the downtrend and is signaling that a reversal is on the way. This is important because something similar happened in March 2007, 7 months before the S&P 500 peaked. After that, from October 2007 to March 2009, the S&P 500 had one of its biggest stock market crashes, falling as much as 56%. Therefore, we need to watch it closely, because, if this recent VIX trend continues, it could mean that the reversal is confirmed and that something similar to 2007 is on the horizon. Now, let's go back to 2001, and as you can see, VIX is also on a long-term downtrend, followed by the white trend line, and every time VIX tried to go above it, would not hold. For instance, in May 2006, for the second time, VIX broke above the white trend line, but could not hold and retraced back down. But in February 2007, VIX had another attempt, and this time, as it started to hold above the white trend line, a new uptrend was created. Now let's analyze the VIX trend combined with the S&P 500 as a pink line. As you can see, after VIX started a strong uptrend, volatility started to get stronger inside S&P, with the first huge pullback in July 2007, but that was not its peak yet. Later on, 3 months later, in October 2007, the S&P 500 found its peak at 1554. After that, the S&P lost its breath and started the first wave of the crash, from October 2007 to November 2007. The second wave down started in May 2008, after a small retrace, and kept going until March 2009, when the S&P found its bottom. Just a moment, please. We have no sponsor, and I am sharing all this top information for free, so please support us at no cost by pressing the like button. We appreciate it. Now, let's go to the bonus, with a very interesting correlation between VIX and S&P 500. Going back to the 2007 chart, as you can see, as the S&P was reaching new lows, VIX was reaching higher levels not seen from decades, and one of its record highs, and increased the volume of its swing. The interesting fact is the almost perfect inverse correlation between VIX and the S&P 500. It does not follow the logic every time, but, clearly, most of the time, as the blue line goes up, the pink goes down or vice versa. Now let's go to the second bonus. Even though VIX is a fear indicator, that does not mean that a temporary VIX spike or a long-term breakout is a signal to sell. Sometimes it is just another opportunity to buy low. For instance, in August 2007, after the long-term breakout in March 2007, there was a nice opportunity to buy, before the S&P was making new highs, in October 2007, when it peaked. So, it is not so easy to analyze VIX as an indicator, because, sometimes, it can indicate an opportunity to buy, and other times, can indicate that it is time to sell, but it is clearly a very powerful indicator, at least much more than those used from the stock market gurus. If you are still watching, you just learned one of the secrets big investors with a different trading perspective use to really understand the stock market, and a completely different approach from all those YouTube stock market gurus. And if we can take advantage from what VIX is telling us, that will give us an edge as investors and traders, combining those signals to other indicators, that can give us an X-ray visual of the stock market, so we can position ourselves before the big events happen. That does not mean we can find out the exact day the big moves will happen, and that, I will leave it to those YouTube stock market gurus who like to predict the stock market crash with their casino mindset. The stock market is always changing and never behaves at the same exact way. Being a successful trader is not about predicting the day it will happen, but finding out when is the best time to stay and to leave with a safety edge. The financial crisis from 2007 led to high volatility periods in the stock market, and the S&P 500 lost about 56% of its value from its October 2007 peak to March 2009, and the VIX index more than tripled. Those who were playing, at the time, certainly, got caught, at some point, on the wrong side of the table, because with casino behavior, the only chance to win you get is from a casino probability, and to invest in the stock market, in a long-term perspective is very different from that. In summary, what we can see from the analysis we have done in this video is that the VIX just started to break out, so we should have a lot more volatility ahead and higher highs on the S&P 500. And that means, speculators are just waiting to earn some money doing what they know best, speculating, as price swings increase. Those same YouTube stock market gurus usually think that volatility means that the stock market will crash, but with experience, you learn that volatility means swings, up and down. And that is the environment in which speculators earn money in the stock market. What VIX is telling us is the current fear sentiment and the current speculation breath, independently from what is happening in wars around the world or job reports. In summary, VIX's recent breakout is a key indicator because it is a long-term breakout from the February 2020 downtrend, and is similar to the one that happened in March 2007 because it was 7 months before the stock market peak. Therefore, traders and investors need to keep track of this new VIX trend and become aware of what could happen to the stock market in the months ahead. Let's just follow the trend that is in front of us. Trying to predict the stock market is very painful, so don't trust YouTube gurus. They will take your money and lead you to the precipice. So, be aware of what is happening to VIX, and stay tuned for more, so don't forget to subscribe and share this experience and knowledge. I see you in the next one.